Welcome to our Markets Magnified podcast, where it's all about the Chinese frenzy today. And I'm joined by ETM Analytics Director, George Glynos. George, thank you very much for chatting with me today. And I have to be honest, tracking China, and I've been tracking China now for a while, feels a lot like standing on the sidelines and watching this behemoth try to transform itself, really one from an economy that has seen immense growth backed by debt-fueled property and infrastructure development, really trying to move into an economy perhaps more focused on consumption, innovation. We've seen large investments go into AI, green tech in China in recent years. But now in this transformation process, they have run into some strong headwinds that's really just culminated in this case where we see weak domestic demand, weak credit growth, a weak credit demand actually, and the deflationary trend is set in. And now the Chinese government has come, it's time for the big guns. We're climbing in with this huge stimulus package. They're cutting lending rates. We know the fiscal measures are on the way. And in all of this, I'm standing and I'm thinking this seems a lot like putting a Band-Aid on a gaping wound happening in China.
Yeah, Ilze-Marie, I think we've got to go back to first principles here just for a second. The best kind of growth that a country can generate is growth that springs up out of savings, and that savings then gets invested. The lower quality version of growth generation is to rely very heavily on credit and the accumulation of debt. Unfortunately for China, they utilized the second option a lot more, despite the fact that they're a massively productive economy with loads of technology and skills. What we found is that they really pushed the accelerator hard, and in order for them to get the supernormal growth rates that they've achieved in recent years and the past decade, they relied quite heavily on the credit cycle. So, it's a function of interest rates being too low. It's a function of a society that then leveraged their balance sheets to invest in specifically property. So real estate at one point made up some 20% of China's GDP, which is just incredible when you consider the size of that economy. As a percent of GDP now, it's dropped to less than half of that. So we're down to probably around 7.5% and falling. And I would say that's a far healthier neighborhood to be in terms of what sort of role real estate should be playing in growth generation within an economy. But the problem is that they're still sitting with the hangover of a rather large property bubble, and that has to correct. And it is busy correcting, and you can see it not just in the amount of months that it takes to clear real estate off a seller's books, but you can also see it in house prices, which have been falling. And the last number that I checked, house prices were down year on year approximately 5%. So, that has implications for household balance sheets. It has also implications for bank balance sheets, and I think that is the reason why the People's Bank of China intervened in the way that they did, because they don't want to engineer a negative credit environment.
But isn't it, given that the credit demand is so weak, lending rates will only then go so far if you cut it, surely, to act as a stimulus measure?
Yeah, I think it's a case of a multifaceted approach, as you quite rightly pointed out. They're also looking at some stimulus measures. Those stimulus measures are obviously there to try and employ more people. In employing more people, you tend to generate more demand more broadly across an economy, and so that can absorb some of the supply of things like real estate, which just helps the market rebalance itself to some degree. But they are easing pressure. Just remember, it's not just easing pressure on households to be able to go and borrow and spend more. It's also easing pressure on the banks themselves. Because if you can just, even if at the margin, prevent house prices from dropping significantly further, then what you're also doing is protecting those bank balance sheets. And those bank balance sheets are imperative if you ever want to produce the next credit upswing. So just remember that a bank can only lend when it's well capitalized. If its balance sheet is constantly being eroded because of the assets that it holds are losing value, then that bank needs to constantly recapitalize itself, which obviously puts some pressure on money markets and squeezes liquidity within those environments. And so you want to try and tackle that as best you can. If you can prevent that from happening, then you can prevent a major downturn, driven in part by the banks having to tighten up the reins, lend less, become more judicious in who they lend their money to, and ultimately the lending standards that push out to the rest of the economy.
You mentioned the fiscal measures that we kind of anticipating still to come. And in one of the pieces that I read, they made the very interesting point that the committee that needs to rubber stamp those fiscal measures are only meeting this October. I think it's towards the end of October. And if the government continues with their past trends of only investing in infrastructure and property development to boost stimulus or to do the stimulus, that can only start in spring next year due to weather conditions. So that's another lag of 6-7 months before those stimulus measures will start feeding through, which is just really pushing back and delaying this process. So is it safe to assume, I think, at this point in time, that the 5% growth target for China might be out of the window for this year, but looking forward, even over to the medium term, that the growth will continue to remain lackluster, at least over the next year, 2 years, perhaps even 3?
Yeah, I think that's a fair call. I think 5% is going to be difficult for them to achieve. I think it's becoming progressively more difficult for them to engineer. And in fact, if you have a look at the IMF's World Economic Outlook projections, they had growth rates closer to around the 3.5% mark. So and that's for the next couple of years. So we are talking about a more stressed environment for China, and you're quite right. Those fiscal stimulus measures are going to take time. Equally, bear in mind that there is a lag between when you implement monetary policy and the impact that it has on the economy. So we're going to be going through a patch right now, probably anywhere between 6 to 12 months, where China is going to find the going a lot tougher. It also happens to coincide with a global slowdown that's unfolding, and we can see that in the numbers in the likes of the US, the UK, Europe. That's why these central banks are all cutting interest rates. It's always a clear sign when central banks collectively are fairly synchronized in their reductions in interest rates. That there's some sort of a global slowdown that's about to unfold, or they wouldn't be behaving in this way. So I think this stretches even a little beyond China, because China is, of course, the biggest exporter to the world. And if demand from the rest of the world is going to be weak, well then that's just one more headwind that you can add to China's equation, which will mean that its growth rate's going to be, as you put it, lackluster.
So how, in this situation, would you as a trading partner or even exporter kind of position yourself for a slower than what we're used to growth in China?
It's tricky, because none of our economies operate as an island. We are all deeply integrated with each other. So weaker demand from very powerful regions like Europe and the UK and America are going to impact. You can't escape that. What you can do is just go back to first principles again. Just get the basics right, and by that I'm talking about companies just making sure that they have somewhat lazy balance sheets, that they don't overextend themselves, that they bide their time, that they make sure that they're as efficient as they can be. I mean, it's just doing the basics right. That's the best way that you can prepare for any economic environment. At the moment, South Africa is enjoying a little bit of a phase, a purple patch, if you like, partly brought about by improved terms of trade. So China might be South Africa's single biggest trading partner, but we are being assisted at the moment by commodity prices that might be a little bit more buoyant. So in South Africa's case, I guess we have a tiny little bit of a buffer. That buffer might extend if the dollar comes under a little more pressure to help buoy those commodity prices. So there may not be a huge need for South Africa to change things wholesale, but it does still require those first principles to be implemented and implemented well, and that's the best you can do. That really is the best you can do.
We also need to remember that China has also found itself in a trade war with the West. It's the 4th of October. I think the EU is actually voting today on those trade tariffs on electric vehicles. So, it's really a mixed bag of headwinds that China is currently facing. There is we've also seen kind of the stock market really just going kaboom on the back of the stimulus measures. And, I don't know if there should be a word of caution, perhaps, on going out too much of a feeding frenzy and just being a bit more cautious, given the fact that there hasn't been a lot of fundamental changes, like you mentioned earlier. But perhaps, maybe they're trading and looking for the inflationary outlook, and that's where this boom is coming from. But perhaps a bit cautious around what's happening there.
I think it's a very important point to raise because a lot of stock markets around the world were in fact expensive before the stimulus package even began. Now, we know that investors by their very nature are forward looking, so they're not going to wait for the event. They're going to try and price it in a little bit before, ahead of time, and that's logical, and that's, since forever is the way that investors tend to operate. At the moment, I think the world is looking for this almost Goldilocks scenario to unfold where, the central banks have moved preemptively enough to avoid a catastrophic repeat of a 2009, for example, crisis. And that because they've moved preemptively and because the central banks now have more tools in their toolbox to try and manage business cycles and credit cycles, etc. I think there's a fair amount of interest in not waiting too long for this big correction that might never come if indeed these central banks are standing at the ready to stimulate as is required to make sure that asset prices remain buoyant. The difficulty always is that the further these stock markets rally, the more they deviate away from, the fundamental value. But then again, the fundamental value actually went out the window quite a few years ago with the advent of quantitative easing and the fact that we are struggling now to understand the full effects of the distortionary effects of that quantitative easing and what it does to prices. So yes, I think you're quite right to highlight these stock markets because they are expensive, and they obviously then naturally bake some volatility and vulnerability into the mix, which is of course unwelcome. But the central banks, make no mistake, they've got a lot vested in what they're doing at the moment. They will not want to see a huge stock market collapse, and I suspect that they will probably step in with some form of stimulus efforts in order to keep those stock market at least buoyant, at the very least from collapsing in a heap, because it's in nobody's interests and would eat very strongly into the credit cycle, which is something, as we discussed a little bit earlier, they want to avoid.
Yeah, so it's there's big global shifts happening, of course, and China is no different. And it's simply something that we will have to adapt to and see whether these measures that the Chinese state has introduced will be sufficient to kickstart the world's manufacturing powerhouse that it once was. George, thank you very much, and I'm sure we'll chat again soon.
Thank you, Ilze-Marie.